Good day, students. I will be doing class exercise 2.3. Pigeon Ltd makes two products, which is named Robbins and Wrens. Information relating to each of these products is set below. We are given the two columns for the two products that this company is producing. We are given the selling price for the product 52 Rand and 91 Rand. We are given the annual sales, which is 15,000 and 18,000 annual sales, which is units that are expected to be sold. We are given the number of sales invoice that were issued each year is 200 and 800. We are given labor time per unit. That means it takes 2 hours to complete 1 unit of Robbins, and it takes 5 hours of labor to complete Wrens product. Then we also have labor rate per hour, which is 10 Rand. That means direct employees are paid 10 Rand in both products. Then after we are given material cost per unit, then this is the direct material cost per unit already calculated for us, 25 Rand and 30 Rand direct material cost per unit. And we are given size of each production batch. That means units here are produced in batches. That means in a group or in a pack or batch of 750 units and 1000. So now these are the number of batches that are produced in this company, which is 750 and 1000 units per batch. Then we have bought in parts per unit. So now these are the bought in parts per unit, and that is 2 and 1 bought in parts per unit. Then the last information that we are given is machine setups per batch, and the machine setup per batch is 2 and 5. That means the machine will be set up twice for one batch in the case of Robbins, and the machine will be set up 5 times in the case of the production of Wren per batch. So now that is the information that is given to us regarding these two products. Then it further says that the financial director of Pigeon Ltd has recently produced the following analysis of overheads and their relevant cost drivers. So now we are given below our overheads, hence they say type of overhead, the cost driver. This is the cost driver, which we normally call it a base to allocate the overhead. So we are given all the overheads for this company, and which is brought in parts handling cost. That means when parts are bought and delivered in the business or in the storage, these are the costs that are incurred to make sure that the parts that are bought from the supplier are handled very, very well. Then that is the number of bought, which is the driver. In this case is the number of bought in parts, and the amount of the overhead is 96,000 rands. Then after we are given material handling cost, which is the cost to handle the material, and the cost driver for that is the number of production batches. So now we have to be able to calculate the number of production batches, and that is 38,000 rands of the overheads. Remember, these overheads are for both products. So now it means this 38,000 must be allocated for this product and allocated for this product. Same as the 96,000 must be allocated for this product and be allocated for this product. So now we will use the allocation method to allocate. We'll allocate our overheads using the method that will be given. Then we are given sales invoicing cost, which is based on the number of invoices issued. So now the total amount of the overhead for this is 20,000 rands, which must be allocated to our products. Then we have machine setup being the number of machine setup. Then this will be the cost driver, and the total of the overhead, as we can see that it is 26,000 rands. And the last overhead is all other overheads, and the cost driver for this overhead is labor hours, and the total amount is 60,000 rands, and the total of all the overheads for the two products, it came to 240,000 rands. So now that is our total overhead cost for the two products. So now we are given these cost drivers, and these cost drivers are very, very, very important. But we will use these cost drivers when we do activity-based costing. Activity-based costing. And this method is normally called ABC. The ABC comes from the activity-based costing. So now we'll only use these cost drivers when we are using activity-based costing. But when we do traditional method, we'll allocate our overheads according to the traditional method, where we use the blanket approach to allocate our overheads. So now let us go to the requirements. It says calculate the total cost per unit, and the profit per unit for each product using traditional full cost method. Remember, traditional full cost method is when we allocate the overheads using one base, and they say of the overheads absorption based on labor hours. That means when we allocate all the overheads under requirement 2.3.1, we must use labor hours, and we allocate all the overheads based on labor hours. Then from there we'll be done. So now that means our total overheads that we see here as 240,000 rands, we have to say divide by the total labor hours that is given to us. In fact, we have to calculate, because we do have labor time here, which is 2 hours per unit and 5 hours per unit. So now when we allocate using the traditional method, we'll only take into account the labor hours to allocate our overheads. So now let me go straight to the answer for this question. So now we are allocating all the overheads, calculating our cost per unit. This is exercise 2.3, class exercise 2.3. Class exercise 2.3. So now we are using traditional method. Remember, we are using traditional method. And in the traditional method, we have to know our direct material first and our direct labor for the two products. Then our overheads will also be needed. We have two products, Robin and Ren. These are the two products that we have that we need the total cost per unit for. Then just draw the lines in between. Then we know that for a product to be complete, it must have the three cost elements: direct material, direct labor, and overheads. So now our direct material, it was given. Direct material, it was already given per unit. In the information that was given, we had a direct material cost, which is material cost per unit, is already given per unit, is 25 rand and 30 rand consecutively for Robins and Wens. Then we write the 25 rand, which is direct material cost, and the 30 rand. Then we need direct labor cost. Our direct labor cost we have to calculate using our rate per hour and the number of hours it takes to complete 1 unit. We know that our direct labor rate, or our employees, are paid 10 rand per hour, 10 rand in producing both products. And we know that it takes 2 hours to complete a unit of robin, and it takes 5 hours to complete a unit of wren. So now if we say 5 times by 10, that will give us the direct labor cost. And if we say 2 times by 10, 10, remember, is the rate per hour. This will give us 20, and this will give us 50. So now this will be the direct labor cost per unit. Then our direct labor cost will be 20 for robin, and it will be 50 for wren. So now this is how the calculations are done. Then we do overheads, and we know that our overheads are allocated using the traditional method. So now in calculating overheads using traditional method, we know that we have to say our overheads rate or our absorption rate is equal to 240,000 rands divided by, remember we were told that our total overheads, or it was given that our total overheads is 240,000 rands, and we are allocating our overheads using a traditional full costing method where labor hours is a base. So now we need to calculate our labor hours, and we know that it takes 2 hours to complete 1 unit of wren, and it is estimated that the annual sales volume will be 15,000 units. So now it means the company will produce and sell 15,000 units, and for each unit that is produced, it takes 2 hours. So now it means if we need total labor hours, we have to say the number of units, which is 15,000 times by 2 hours. That will give us 30,000 hours of labor for robins. And again, we know that it takes 5 hours of labor to complete 1 unit of wren, and we produced and sold 18,000 units. So now if we need the total hours that is needed to manufacture 18,000 units, we need to multiply the number of units that were manufactured and sold by the number of hours it takes to complete 1 unit. So now that will give us the total hours of production. Therefore now we say 18 times by 5. And if we say 18 times by 5, let us check. 18,000 times by 5, that gives us 90,000 hours. And here we said 15 times by 2, and that gave us 30,000 hours. So now if you say 30,000 plus 90,000, that gives us 120,000 hours, of which 30,000 is the hours to complete 15,000 units of robins, and 90,000 hours is the total hours that are needed to complete 18,000 units of wren product. So now from here we can do our rate, where we say 240 times by divide by 120,000 hours. That will give us the overhead rate, and our overhead rate will be 240,000 rands. 240,000 rands divide by 120,000 rands. That will be 2 rand per labor hour. So now this is our overhead rate. It is 2 rand per labor hour. and this is 2 rand per labor hour. Then we need to allocate to product Robben. Our overhead cost per unit will be 2 rand times by the number of hours that are needed to complete 1 unit. So now it will be 2 rand times by the number of hours that are needed to complete 1 unit. And we know that the number of hours to complete 1 unit is given labor hours per unit. It is labor hours per unit, it is 2 hours, and labor hours per unit, it is 5 hours. So now we say times by 2, and if we multiply this by 2, it will give us 4 rand of the overhead. Then we calculate the overhead cost per unit for Robben. It will be 2 rand, which is the rate, our overhead recovery rate or absorption rate. We say 2 times by the number of hours it takes to complete 1 unit of REN, and it takes 5 hours to complete 1 unit of REN. Then we times that by 5, then it will give us the total of 10 RENs. Then now we go and we allocate that to our total cost. We allocate that to our total cost. It's 4 rand, and here it is 10 rand. Then from here we can totalize or calculate the total for all our overheads. It's 20 plus 20, 25 plus 20 plus 4 is 20 plus 25 plus 4, 25 plus 20 plus 4, it is 49. So the total cost here is 49, and the second one is 30 plus 50 plus 10, and that gives us 90 rand as the total cost. So now that is the total cost per unit. Total cost per unit. Remember, the requirement was to calculate the profit. So now we need to know the selling price. The requirement was to calculate the profit. It said calculate the total cost per unit and the profit per unit for each of the product using traditional method. So now we are using first traditional method, and we have calculated the cost, and we need to know the selling price for each product. And we know that the selling price for Robben's is 52 rand and 91 rand for REN. So now let us allocate the selling price 52 and 91. Our selling price is 52 rand, and here it is 91 cents. Then from here now we can determine if have we made a profit or a loss per unit. Profit per unit, then this will give us 3 rand, and this will give us 1 rand. So now in this case we made profits in both products, and for the first product the profit is 3 rand, and for the second product the profit is just 1 rand. At the end we made profit in both instances. So now this was the first requirement, where we calculated the total cost and the selling price per unit using the traditional method of allocating overheads. Then now we go straight to the second requirement, and the second requirement is 2.3.2, where we are still required, remember the instruction is here, we are still required to calculate the total cost per unit and the profit per unit for each product using the activity based costing method now. So now it means we are using ABC, And remember, ABC, we allocate our overheads using the different bases that are given. That means using the cost drivers. That means for each overhead, we have to use the cost driver or the base for that overhead. Then we allocate to the two products until we are done. Therefore, now we'll do that from the first overhead up to the last overhead, allocating that overhead to the two products using the cost drivers that are given here in the second column as the cost drivers. That means the base or what drives the cost. So now we are still doing the same thing, but just using a different method. So now I will be doing that table for us here. Next page. So I am doing number 2.3.2. 2.3.2. We are still calculating the cost for Rubens and for Ren and remember the cost, it is still per unit, and we still need direct material, and direct material does not change. We still take the same amount as we did in the first calculation. So now we still say direct material is 25 and direct labor is 30 rand, and direct labor is 20 and 50. So now those two costs, they do not change because they are directly related to production, and we can trace them and just allocate them to where they belong. So now we take 25 and 30 rand. 25 and 30 is our direct material and our direct labor. Our direct labor cost is given to be, direct labor cost is 20 rand and 50 rand consecutively. So we record 20 rand and 50 rand. Then after we have all the overheads. So now we have to list all the overheads that we have, and I will do the calculation for all of them. So now the first overhead that we have here as it is given is bought in parts handling cost. Bought in parts handling cost. Bought in parts. Bought in parts handling cost. That means the cost that we incur to handle the parts that are bought into the business. The second overhead is material handling cost. Material handling cost, the cost that we incur to handle the material. Material handling cost. The next overhead is sales invoice cost, sales invoicing costs. Sales invoicing cost. And the sales invoicing cost has a cost driver of the number of invoices that were issued. And the next one is machine setup costs. Machine setup costs. Machine setup cost. Which is the cost we incur to reset the machine or to set the machine. The last overhead is all other overheads. All other overheads, which is other overheads. and that is just other. So now we have to allocate these overheads using their basis of allocation or the cost drivers as it is given. So now let us go straight and do the calculations and the allocation of all these overheads. So now the first overhead is bought in parts. Remember, we want to allocate these overheads to the two products. And the two products that we have is Robin and Rand. So let us just do a table where we have to allocate these overheads to the two products. Then I just want to have this product here, and these are just my workings. Workings of allocation. That means I'm just doing my calculations here to allocate these two products. I have Robin, I have Ren, and the first overhead that we have here is bought in parts handling cost, bought in parts, bought in parts handling cost. So now these are just my workings, because I first have to calculate the total cost for these overheads. Then after I'm done with their total cost, then I will be able to divide by the number of units to get to the overhead cost per unit. So now let us first check the amount of the first overhead. And the amount of the first overhead is 96,000 rands. And the cost driver is the number of bought in parts. And the number of bought in parts is given here. They say bought in parts per unit, which is 2 and 1. The number of bought in parts is 2, and it is per unit. Take note of that. It is per unit. Bought in parts is per unit. And we have 2 bought in parts per unit. That means for every unit there are 2 parts that are bought in. And how many units were manufactured and sold? We manufactured and sold 15,000 units. So now if we manufactured and we sold 15,000 units, it means bought in parts will be 15,000 times by the number of bought in parts per unit, which is 2 bought in parts per unit. Then that will give us 30,000. But let me just do the calculations for us here. We first have to calculate our bought in parts rate. We first have to calculate our bought in parts rates. Bought in parts rate. We first have to calculate all the rates. And we know that to calculate the rate for the overhead, you take the overhead in total, which is 96,000, and you divide by the cost driver or by the base. And we know that in this case we have 2 times by 15,000 plus the bought in parts for Ren is 1 part per unit, and we manufactured and sold 18,000 units. Therefore now it will be 1 bought in parts times by the number of units that were manufactured and sold, which is 18,000 units. So now from here we can be able to calculate the overhead rate, 96,000. Then now we have to do the calculations where we say 2 times by 15,000, and that is 30,000. Then we say 30,000 plus, and we continue by saying 1 times by 18, that will give us 18,000. Then it will be 96,000 rands divide by 30 plus 18,000, that will give us 48,000, and that will give us the rate, and the rate will be 96,000 divided by 48,000. It will be 2 rand per part. Therefore, now this is our rate. Then we have to allocate to the product Robin. Then we take our overhead rate, which is 2 rand, we multiply it by the number of units, the number of bought-in parts, which is 30,000. Remember, we said it is 30,000 bought-in parts. So now we times by 30,000, and if we times that by 30,000, it will give us the allocation of the overhead as 60,000 for Ruben, and for product Ren, we take our same 2 rand, which is the 2 rand per bought-in parts. Then we multiply by the base. Remember, our base was 18,000, the total in the case of Ren, because we said 1 times by 18, we said 1 times by 18,000, it gave us the same 18,000. Then if we multiply that by 18,000, it will give us 36,000. So now this is how we allocate this overhead. This is how we do the allocation. So now we have allocated the 2. It means this amount go to the Ren product and 60,000 go to Robin as the overhead. And if you say 60,000 plus 36,000, that's supposed to give you the same amount that you were allocating, because we're allocating 96,000. Make sure that your allocation total is equal to the cost of the overhead. And these two amounts, they are honestly equal to 96,000. So now 60,000 go to Robin and 36,000 goes to Ren. So now let us just record that immediately. Then it is 60,000 and this is 36,000. This is the total allocation. We still have to divide by the number of units to get to the overhead cost per unit, because we are required to calculate our overhead cost per unit and the profit per unit. Then now we go to the second overhead and we do the same thing. The second overhead is material handling cost, and the total amount is 38,000, and we have to allocate using the cost driver, and the cost driver is the number of the production batches, the number of production batches. So now let us record that material handling cost. Material handling cost. Our material handling cost and let me just erase here. So now our material handling cost, we know that it is an amount of 38,000 rands. It is an amount of 38,000 rands. There is 38,000 rands. So now let us do the rate again. Material handling rate. Material handling. Remember, the formula says budgeted overhead divided by the budgeted base, of which the base in this case is the cost driver, being the number of production overheads. Our total overhead is 38,000 that we need to allocate. So now let us check how can we calculate this overhead and allocate it to the two products. Let us check the number of production batches. We are told that the cost driver is the number of production batches, and we know that the size of the batch is 750, and we know that the machine setup per batch is 2 times and it is 5 times. That's what we know. And we know, okay, we know the 2 so far. So now let us check what can we do to use the information that is given to do the calculations. The size of the batch is 750 and the size of the batch here is 1000. And the machine setup per batch, which is the number of times the machine is set up per batch, is 2 times, and here it is 5 times. So now it means if the size of the production batch is 750, that means for every 750 units is one batch and 1000 units is one batch. And we produced and expect to sell 15,000 units. So now obviously if one batch is 750, it means 2 batches will be 15,000 units. So now let us calculate our batches first. Let us calculate our batches, calculating batches out of the 15,000 units. Let me just draw a line here. If we say we calculate batches, we say the number of units, 15,000 units, and we divide by 750, and if we do that, it will give us batches 15,000 divide by 700 divide by 750, then we get to 20. That means for the 15,000 units there were 20 batches, of each is 750. So now that means there were 750 units that were manufactured 20 times in simple terms. So now in this case we have 1000 batches that are manufactured, 1000 units per batch, and 18,000 units were manufactured. So now let us once again calculate the batches. This is product Robin, and this is Ren. So now it means we take the number of units 18,000 and we divide by 1000. That will give us 18. Then if we have 18 here and we have 20, it means the total will be 38. So now let us go and check again what was required. We are told that material handling cost is based on the number of production batches, and we know that our calculation showed us that we have 20 number of batches that were made out of we have 20 batches that were made out of the total batch of 750, and we have 18 that was out of the 18,000 units, which is the number of batches. So now let us do the calculation of this overhead, which is material handling cost. So now we have our total of the base being 20 and 18. That means it becomes 38. So we say 38,000 rands divided by 38 batches. I want to highlight that it's 38 batches, and each batch, in the case of Robin, each batch has 750 units, and here each batch has 1000 units. And in this case there were 18 batches that were made, and here there are 20 batches that were made, and each batch is 750 and 1000 for Ruben and Ren. So now it will give us our overhead rate, and our overhead rate is an amount of 1000 units, 1000 per batch. So now that is our rate, and if we have that rate, we have to multiply by 20, and we multiply that 1000 again by 18. Then after we have done that, we'll be able to allocate our overheads. So now let us do the allocation for the product Robin. Robin, we say 1000 times by 20, and if you say 1000 times by 20, that will give us 20,000. That must be allocated to product Robin out of the 38,000. Then we go to Ren, and we say our rate, which is 1000 times by 18, and that will give us 18,000. And if you say 20,000 plus 18,000, it should give you the same 38,000 rands, which is the 38,000 rands that you were allocating. Don't forget, this is the amount that we were allocating. So now let us go and allocate that 20 and 18,000 in our table. Then we record 20,000 and 18,000 respectively. I hope, guys, we are all on the same page. We first have to calculate our rate, then we multiply, then that will give us the total overhead to be allocated. Now let us continue to the second one, and it says sales invoicing cost, which is the number of invoices issued. Sales invoicing cost is the number of the invoices that were issued, and the total of that overhead is 20,000 rands. So now we have to know the number of the invoices that were issued, and we know that the number of the invoices that were issued per year, remember this is already in total, so there's nothing to calculate. It is 200 and 800. So now it means the total here will be 1000. And let me just do now other things that I'm seeing now. And we said here, we said 15,000 divided by 750, that gave us 20, and we said 18,000 divided by 1000, that gave us 18, and the total was 38. And here we have 800 plus 200, and this gave us 1000. So now it means when we allocate this 20,000, we have to divide by the total of the base, which is 1000, and that is sales invoicing cost. Sales invoicing cost. Sales invoicing cost is the next overhead. Sales invoicing cost, and when we allocate that, we have to calculate our sales rate, and our total sales is 20,000 rands, and we divide by the total of the cost driver, and the total of the cost driver, which is the number of sales invoice, is total of the two, and that gave us 1000. Then we divide by 1000, and if we say 20 divided by 1000, that gives us 20 rand per invoice. Then we allocate that to Ruben, and we say our rate, which is 20, times by the overhead for Ruben, the total base for Ruben, or cost driver for Ruben, and that is 200, times by 200. And that will give us an amount of the allocation of this overhead as 4000. And the next one is Ren, and we take the 20 rand, which is the same 20 rand, nothing has changed, the same 20 rand, we times by the cost driver for Ren, and the cost driver for Ren total is that 800, times by 800, and that will give us the amount of 16,000. 8 times by 2 will give us 16,000. And now if you see, still my principle is correct. 16,000 plus 4,000 still gives us 20,000. So now let us just go and paste those numbers in the allocation workings. We have 4,000 and 16,000. 4,000 and 16,000. 4,000 and 16,000. So now these were our allocation. Then let us continue with the next overhead. And the next overhead is material setup cost. Material setup cost. And this is based on the number of machine setups. So now it means this will come straight here. Machine setups per batch. And this is very important because they say machine setup per batch. Per batch. And we know that here we had 20 batches. Here we had 20 batches, and here we had 18 batches. We had 20 and 18 batches. Let me just erase that so that we start in the fresh. So now this is machine setup per batch. It means we need to know the number of batches. And we said that for Ruben, one batch has 750 units, and for Ren, one batch has 1000 units. And we said in the case of Ruben, if we say 15,000 units divided by 750, that will give us 20 batches. And for Ren, we said 18,000 units. This is units, this is units. Divide by also the units that are needed per batch, which is 1000, and that will give us 18 batches. So now these are the number of batches that we have. So now it means when they are telling us that the machine setup cost is based on the number of machine setups, of which they say machine setups per batch. So now it means we need to say the number of batches for product Ruben times by 2, and the number of batches for product Wen times by 5, and that will give us the total machine setups per batch, or the total number of batches. So now we say 2 times by 20, that gives us 40. Where is that coming from? It is the 20 and it is the 18. Then here it will be 5 times by 18. Then we have to check now if 5 times by 18, what does it give us? 5 times by 18, it gives us 90. That is 90. So now we have 40 and we have 90. Then now we have to calculate the total, and the total of the two will be 120. Then we have to calculate the machine setup cost, or the machine setup rate. Machine setup overhead rate is the total cost, which is 26,000. Remember, that is the 26,000 I'm talking about. The cost of this overhead. Divide by the number of machine setups, and the number of machine setups is 40 machine setups, because there are 2 setups that are done for each batch, and there were 20 batches that were done for product Ruben, and there are 5 machine setups that are done per batch, and there are 18 batches that were done for product Ren. Then that gave us the total of 90. Therefore now we say 40 plus 90 will give us 120. Then we say 26,000 divide by 100, or that will be 130, not 120. Then our rate will be 26,000 divide by 130, and it will be 2,000. And it's 2,000 per machine setup. 2,000 per machine setup. That means every time the machine is set up, the company will incur an amount of 2,000 per machine setup. So now when we allocate our overhead to our 2 products, which is Ruben, we don't change. The same principle applies. Take the rate of 2,000, you multiply by the total batches, number of batches, the total number of machine setups per batch, times by 40. Then that will be 2,000 times by 40 times by 40. That gives us 80. Let me confirm that. 2,000 times by 40, that gives us, it can't be 80,000. Okay, let us check. The first calculation is 26,000 divided by 130. Okay, it's 200, not 2,000. Sorry for that. So it's 200, not 2,000. Then we times by 200, and that gives us 8,000. Then for product Ren, we say 200 of the rate times by 90, and if we multiply that 200 by 90, that gives us 18,000. And if we say 18,000 plus 8,000, that gives us 26,000, and 26,000 is the total overhead that we're allocating, that total overhead. So now let us record that in our workings. 8,000, and it is 8,000 and 18,000, and that overhead is machine setup costs. Machine setup costs. Machine setup costs. The last one is other overheads. And under other overheads, now we have to use labor hours as the base. Remember, we have to use total labor hours because this is the total overhead of 60,000 rands. So now if this is total overheads, we need total labor hours, as I've said, and we are told that our labor hours per unit, or our labor time per unit, is 2 hours and 5 hours for Robins and Wren's product respectively. So now if it takes 2 hours to produce or to complete 1 unit of Robin, and we produced 15,000 units, it means if we say 15 times by 2, that will give us 30,000 hours. So now these are the hours, and 18 times by the number of labor hours it takes to complete 1 unit, which is 5, that will give us 18,000 by 5, that will give us 18,000 by 5 by 5, it gives us 90,000 hours. So now we need 90,000 hours to complete product Wren, and we need 30,000 hours to complete product Robins. Meaning now our labor hours as a base, we have to say 30 plus 90 will give us 120,000 hours. So now let us do our other overhead rate. Other overhead rate. Other overhead rate. And we take the cost and the cost is 60,000 rands, divide by the total cost driver, and the total cost driver is 120,000 hours. The 120,000 hours, which is made of 30 and 90. Then that will be, it will definitely be half 60,000 divide by 120,000, that gives us 50 cents per labor hour. This is per labor hour. Then now we allocate to product Robin or Robin. When we allocate, we say 50 cents times by 30,000 hours. Remember, the 30,000 hours is this 30,000 hours, where we said 15,000 units times by the number of hours it takes to complete 1 unit. Then now that will be 15,000 rands. Then we allocate to product Wren, and this will be 50 cents times by the number of hours to complete product Wren, which is 90,000 hours to complete 18,000 units of product Wren. Then this will give us the total of 0.5 times by 90, supposed to be 45 years, 45,000 rands. And if we say once again 15 plus 45, this gives us 60,000 rands, which is the same 60,000 rands that we're allocating, that 60,000 rands, that one. So now we are definitely still on par. So now let us allocate this overhead and record it to where we're supposed to record it, 15,000 and 45,000. This is 15,000 and it is 45,000. So now we have allocated all these overheads and we have allocated them in total to the two products. Remember, the requirement was to calculate total cost per unit, and these costs are per unit. The direct material is per unit, the direct labor is per unit. So now it means when we allocate these overheads here now, they must be also per unit, because we have to calculate total cost per unit. But the one that we have done here are the totals. So now we just have to say divide by the number of units that were manufactured in by the product. So now for product Ruben, we manufactured, if I still remember, 15,000 units. So now we'll just have to say divide by 15,000, divide by 15,000 throughout, divide by 15,000 units, divide by 15,000 units, divide by 15,000 units, divide by 15,000 units, because we are looking for the cost per unit. And here we divide by the number of units, which is 18,000 units. Remember, the units were given here. We're told that 15,000 units and 18,000 units of annual sales volume. So that is the units that we divide with, so that we get the overhead cost per unit. Then we divide by 18,000, we divide by 18,000, and we divide by 18,000, and we'll divide by 18,000. So now this is what I will be doing in the calculations now with you. So let me just have my calculator there available. So now we see 60,000 divided by 15,000, that is 4 rand, and the 4 rand will go to straight to the first overhead, which is bought in parts, 4 rand. Bought in parts handling cost is 4 rand. Then we do the same thing. We say 36,000 divided by 18,000, divide by 18,000. That gives us 2 rand, and 2 rand goes straight to the overhead for product rand. Then we come to the second overhead, and the second overhead is material handling cost, which is 20,000. This 20,000 divide by 15,000, that is 133 cents, and we record 133 cents here. Then for the second one we have 18,000. This is where we are, 18,000 divide by 18,000 units. That will give us 1, obviously. 18,000 rands divide by 18,000 units, that is 1 rand. Then we record that 1 rand there. record the 1 rand. Then we also have to take into account the next overhead, and the next overhead is sales invoicing cost, and the sales invoicing cost is 4,000 divided by 15,000, that is 27 cents, and we record 27 cents. Then after we take the next overhead, or the same overhead, 16,000 divided by 18,000, this is where we are. 16,000 divided by 18,000. Remember, 18,000 is the units. That gives us 89 cents. Then we have 89 cents. The other overhead before the last one is machine setup costs. Machine setup costs. The machine setup cost is 8,000 divided by 15,000 units, because we are looking for the cost per unit. That is 53 cents. That is 53 cents. 53 cents. Then the next product is 18,000 divided by 18,000. That will give us 1 rand again. 18,000 divided by 18,000 will be 1 for product rand. And the last overhead is other overheads. 15,000 divided by 15,000 will give us 1. Then we record that as 1. And the next product, we have other overheads as 45,000 divided by 18,000. 45,000 divided by 18,000. That is 2 rand 50 cents. That gives us 2 rand 50 cents. So now these are the total overhead cost per unit and the total direct cost per unit. So now, with that being said, let me just complete this exercise, then we are done. So now we calculate our total cost per unit, and our total cost per unit using ABC. Remember, we are using activity-based costing now. Our total cost per unit is 25 plus 20 plus 4 plus 1.33 plus 0.27 plus 0.53 plus 1 is 52 rand 13 cents. 52 rand 13 cents. 52 rand 13 cents. Second one is 30 plus 50 plus 2 plus 1 plus, this is 89 cents. $0.89 plus 1 plus 2 rand 50. Then the total is 87 rand 39 cents. 87 rand 39 cents. Then now that is our total cost. We have to compare that with the selling price so that we are able to determine if we made a profit or a loss. Our selling price did not change in this case. We had selling price of 52 rand. Remember, this is the selling price that we had from the beginning, 52 rand and 91 cents consecutively for Robben and rand, 91 cents. Then we calculate our selling price per unit, which is the last stage. Selling price per unit. Our profit per unit, not selling price. Profit per unit. And our profit per unit will be the difference between the selling price and the cost price, and the profit will be 13 cents, and here the profit will be 3 rand 61 cents. So now the last question, which I will just do an overview, and I will not comment that much on that. The memorandum makes it very, very clear. The next question or the next requirement is to comment on your findings. Remember, we are comparing traditional full costing, where the overheads are allocated using one base. This is what we have done in this exercise. We have done traditional costing, where all the overheads were allocated using the base of labor hours to all of them. Then we did activity-based costing, which is called ABC. And we calculated our total cost per unit using activity-based costing, where all the overheads were allocated using different bases. And these were the workings that I did. Allocated all of them in total, and I divided by the number of units. Then now we have to compare the two. And if you see in the first scenario, when we use traditional method or traditional allocation or the blanket approach, we made a profit of 3 rand and a profit of 1 rand, respectively Robben and Ren. And the total cost for the Robben product was 49, and here it was 90. And if we compare those two, currently now in the ABC, the total cost is 52 rand 13 cents, which in this case it was 49 rand. So now that means in the ABC method, we have a slight higher cost of product Robben per unit, while in the Rand product we had a total cost of 90 rand using traditional method, but in the ABC there is slight lower cost per unit in total as 87 rand 39 cents, which resulted to a higher profit of 3 rand 61 cents. However, in the traditional method, we had a total cost for product Robben that resulted, in the ABC, we had a total cost of 52 rand 13 cents in comparison with the total cost of 49 rand. And now, because of the ABC approach, cost total per unit, which is 52, now it resulted to a lower profit of only 13 cents. So when you compare, you just look at another method, how much was the total cost per unit, and you go to the other method and say, okay, there is a slight increase or a decrease, and you go to the profit, and the profit, it was 3 rand and 1 rand. Then you compare the two and you realize that the profit is very low in the ABC, although it was 3 rand in the traditional method. Please go and check the comments. The comments are there, and just the comparison of the profit and the difference in the selling price, difference in profits and the difference in the total cost. So now with that being said, guys, thank you.